Hello, everyone, and welcome to this Family Building Society podcast on later life lending. The later life lending is set to become an even more important part of the mortgage market, with the FCA saying in its recent discussion paper that lifetime mortgages and retirement interest-only deals were becoming increasingly mainstream. They also pointed to the average age of the first-time buyer increasing, along with average term length, with them adding that this could create more opportunities in the space. But this is a complex area. There's a risk that equity might be eroded by longer terms. There's some restrictive lender criteria around terms and maximum age, higher product pricing, and lack of awareness as potential challenges. We're going to untangle some of that complexity by looking at the current outlook of the market, along with key opportunities and challenges. Joining me today is Neil Cadwallader, Business Development Manager for South Wales and South West, and Stuart Heavens, Business Development Manager for the South Coast. Welcome both. So I suppose we'll kick off with quite a wide question, which is what, from your perspective, is the general outlook of the later life lending market, and what has the performance been like so far this year?
The general outlook for the later life market in the UK is quite good at the moment. The UK finance data that I have is for quarter one of this year. In quarter one 2025, we were up, and also throughout the course of 2024, the later life, the over 55 market increased quarter on quarter throughout the course of the year, and it's continued to increase then into quarter one of this year. Ultimately, with the later life lending, more and more people will become eligible for it. So it will always be a growing area of the market. The UK has an aging population and people are getting older. I did a presentation last year where I spent quite a bit of time talking about how average life expectancy has increased over the last 100 years or so. Now, I'm not going to bore you all with the figures that I could have researched for that, but ultimately, people are living longer and people, therefore, need to borrow later in life. People are working later as well. So it is a growing area of the market all round.
The later life lending space, there is a broad range of products, but one thing that I think is interesting that to support this segment, it doesn't just have to be later life lending deals. I don't know if that's something that I know Family Building Society specializes in that intergenerational lending. What kind of products do you guys think would help meet this growing demand?
The list of growing products that would normally traditionally be used would be kind of RIOs, equity release, that type of product. I think that the market is awakening to the fact that those aren't the only two products that would be ideal for customers, even if it's not for the end journey. It may be during the journey, because later life lending can be actually viewed as different ages and different eyes. Invariably, FCA looks at it at normally about 55 years of age onwards. And at that time of life, later life lending products like the ones I've just mentioned actually don't work very well for customers, primarily because, believe it or not, they're too young. The calculators work against them. And also you have like where there's a joint life case, and unfortunately lenders will normally they'll take one person away, they'll do that death calculation, and so affordability is not based on both couples. And that is where kind of lenders like ourselves, who have been lending using interest only high street products, where we can take up to 4 applicants and 4 incomes, and that completely transforms the affordability normally for that sector. And as I say, we may not be the end goal, we may be part of the journey, but we can actually provide kind of cheaper interest-only lending to the masses as such, because you can get it for people on it, and that we can be a segment of that journey going forward. So we're going to be part of that financial advice journey then, so to speak.
I think it's an interesting point in the discussion paper that they did point to the pricing of some later life lending deals as maybe being a bit too high, like those retirement interest only or lifetime mortgages. So actually using those interest only deals that you mentioned and boosting that affordability with multiple applicants is a very important point. So that's one key opportunity, is actually using something like interest only in that scenario. Are there other opportunities that you guys see in the market, new product innovations Family Building Society offers?
This is with the older borrower space, not necessarily a new product, but it's the tried and tested repayment mortgage. We got to age 95 on a repayment mortgage as an example, and a lot of borrowers look at interest only because they feel that they want to minimize their monthly payments. However, if you've got a 70-year-old with the high street, they can get maybe a 5-year term at best, maybe 10-year term. Whereas with us, they can come to us and go for a 25-year mortgage term. And so even if interest only isn't necessarily what they're looking for, because appetite from broker to broker can vary as it can with clients. So if interest only isn't up their street and neither is a lifetime mortgage, then they can look at the kind of the tried and tested repayment mortgage, pay for age 95. That will help minimize the monthly payments and hopefully make it much more palatable for the older borrower who might want to pass on their home as inheritance to their loved ones. And then there are also obviously other products available, such as Joint Borrower Sole Proprietor, even where someone can help support an older borrower. There is a lot of opportunity in the market for the definition of a 55 plus. A lot of the high street will service them. As Neil says, lifetime mortgages aren't necessarily going to leverage the amount that the client wants. But for me, the 75 plus market, a lot of our borrowers are in their 70s or beyond. There's over £1 trillion worth of property or equity owned by clients that are 75 plus. So there's a big space in there for borrowers that might want to look at releasing money either for lifestyle or through equity release, or to help support their family through gifting. So there are big opportunities out there.
Neil, do you have anything that you want to add to that? Any other key opportunities that you see in the space?
The opportunity really is in education, because as much as it's the opportunity is a fiscal thing in the end, it's the education generally of brokers who maybe don't normally deal with later life lending, or have this opinion of that later life lending is in their 60s, 70s, and 80s and further. Whereas invariably, as Stuart has just noted, having the level of unlocked equity, which the FCA paper, which is just recently kind of highlighted, they want brokers to look at people 55 plus. I mean, the total wealth locked up in 55 years of age in the UK, believe it or not, is a staggering £3.7 trillion. So you can imagine that, bless, this government is not going to be reducing taxes. In fact, it's going to be increasing taxes for IHT. So, the use of normal mortgage products and later life lending products, I think, is going to increase purely because of look at the average 60-year-old. They say that the 60 is the new 40. I certainly hope so. I'm there next year myself. So, at the end of the day, it's a case of people are living longer, having fuller lives. They need to access the equity in their property. Who do they need? They need lenders like us, and they need brokers, independent brokers, to give that advice. And also then, as I say, education is basically educating not just the opportunities, but the support that's needed for clients to make these decisions as they go through their 50s, 60s, and 70s, which I think is, again, a space that Family Building Society can come in and really help with.
I know you guys have a really good education hub on your intermediaries page, which has a lot of resources there. So if brokers do want to kind of learn more about the segment, if they, like you said, if they don't deal with it very often, then that can be very useful for them as well. And I think something that Stuart mentioned was talking about if you went through a high street lender, then you might be able to get a 5-year term, or the terms might be more limited. There are benefits of using a mutual building society like yourself as opposed to a high street bank. I was wondering if you could kind of go into that a little bit more.
The building society market tends to understand the later life lending better, because the high street's definition of later life lending is perhaps to 75, and it's much more restricted. Whereas with building societies, you can get longer terms, whether that's to age 85, whether that's to 90 or even 95 on repayment, whether that's allowing interest only. A lot of the high street won't allow interest only to people who are in or around retirement or looking to use pension incomes. A lot of the high street have restrictive or prohibitive minimum income requirements of 50, 75, £100,000. People that are retired may well have a lower income than those that are working age. So they might not necessarily be able to overcome the barriers that are put in place by the high street to enable them to have interest only. One of the things that I'm quite passionate about when I'm speaking to my brokers is, if someone has got a retirement income and they've got a lower income, Why should they be forced down the repayment route? Just because they have a lower disposable income, why should they be forced to use more of that each month on a repayment mortgage when actually they have the equity within the property that they can downsize in 5, 10, 15 years' time? And they're the prime candidate in my mind to go for interest only now so they can service the interest and then they can downsize with their equity in the future if that's what's right for them. And that's where the advice process is important. And that ties in nicely with what Neil just mentioned. Neil touched on IHT very briefly. And for me, I'm not a tax advisor, never have been, and I would encourage people to receive appropriate tax advice. But inheritance tax and planning, an opportunity for brokers in this market is to have the relationships with the right fellow professionals that they can refer leads over to in order to receive that advice. IHT planning is one thing that a lot of brokers do come to us for in terms of the borrowing requirements. A property over a certain amount adds obviously to the estate. On top of that, people used to be safe investing in pension pots and SIPs and drawdown pensions. It used to be exempt from IHT, or is currently exempt from IHT. Under the current plans, unless they change, from April 27, pension pots will now form part of the estate on death, and that will increase the average person's IHT liability and push more people into the IHT brackets. If someone has a pension pot there, they can potentially look at, without touching on tax advice, they can look at potentially exempt transfers. They can gift money to their children now. Look at IHT bonds and IHT planning. They can look at ways of reducing their IHT liability in the future by taking the right advice now, which may include creating a debt against their house to create a debt against their estate and using their pensions or investments to service that. So from a broker's perspective, the biggest opportunity that they have is to find those fellow professionals who they can make referrals to receive appropriate tax advice. And likewise, they may then need a mortgage advisor in order to facilitate the advice on the mortgages for their clients.
Yeah, I think that's a really good point, is finding the right partnerships. If it isn't necessarily something that you do very often, actually finding someone who you trust to kind of refer things, and you don't want to breach that tax advice line or go into an area that you may not be as familiar with. So it's really important to get trusted partners. I suppose, just to round off, if there was one key trend that you wanted to signal to brokers so that they were aware of, what would it be and why?
For myself, I would say now's the time to broaden your horizons and look outside the box. Um, from my own kind of my brokers, and I'm sure it's the same as Stuart's. As far as Family Building Society goes, we quite bespoke lending, and I think that can also lend to case sizes, which invariably for a broker would actually kind of also be a benefit for incomes. But you have to have the lender that's able to understand the case in the first place. And that's something that Family Building Society can do. Stuart is and myself, and we've got another 6 other face-to-face BDMs who all cover their areas across England and Wales. It's building that education piece, that relationship piece for them to understand where they can actually look at their client base and where they can maybe expand advice and incomes at the end of it, while giving great advice to clients who, as Stuart has already highlighted, in the next couple of years is going to need advice even more than normal, because of the regulation is coming down with taxation changes and so forth. That they do is going to put even a bigger financial burden on clients' finances and estates, future estates.
Stuart, if you wanted brokers to take away one thing from this episode, what would it be?
Not to be scared of later life lending. It's easy to try and allow customers' mortgages to finish by retirement, and for customers that may be super to advice. There will be clients for whom it is right to lend into retirement, whether that's using pension pots that aren't yet being drawn from, whether that's using investment funds, whether you're using rental income, even limited companies that are now providing a passive income. There's a whole spectrum of incomes that clients can use into retirement. That means that it's no longer considered the standard to finish it by retirement. There are other options available, and lean on your BDM. Brokers are very experienced when it comes to dealing with the market as a whole, and we're, as BDMs at Family, particularly experienced when it comes to later life lending and older borrowers. And there will be peers out there also that can assist. So speak to your BDM and run cases past them, find out what sort of documents would be needed. And I'm always happy to proverbially hold my broker's hands when placing older borrower cases. So no need to try and shy away from them, embrace them. It's a growing area of the market and it's a good opportunity for your businesses.
Well, unfortunately, we have run out of time in this episode. I think the key takeaways are, this is an area that is just set to grow. You don't just have to think about traditional later life lending products like your RIOs or your lifetime mortgages. You can also think about interest only or repayment mortgages or joint borrower sole proprietor. And, it's definitely educate yourself, use resources like Family Building Society's Education Hub. In our next episode, we are going to be talking more about, the variety of products available. So please tune into our next episode and look forward to seeing you then.